Have you ever been told that you need to consider an FHA loan instead of a conventional loan? Well, this episode is for you because that framing is usually incomplete and in some cases it's just wrong.
Welcome to Mortgage Made Simple, the podcast that cuts through the confusion of home loans and delivers exactly what you need to know. Fast, simple, and without the fluff.
So today I want to walk through FHA loans and the way that they actually come up in real files. So not as a beginner overview or not as a fallback option, but as a comparison point when you're weighing an FHA loan compared to a conventional loan and deciding which structure actually makes sense. So FHA can get a little confusing sometimes. An FHA loan is insured by the Federal Housing Administration. And so what that means is the insurance changes how the loan is underwritten then. It doesn't eliminate risk, but it shifts some of that risk from the lender and onto the FHA insurance fund side. So what that means in real terms then is this: if the loan defaults, the lender isn't absorbing the full loss in the same way that it would on a conventional loan. So because the lender's exposure is lower, the underwriting box, if you want to call it that, is going to be a little bit wider. So that's why FHA does allow for these different tolerances around credit history, debt to income ratios, and down payment structure. And so that's the big difference right there. So let's talk about the down payment first, because this is where FHA loans often get misunderstood, because FHA, yes, does require 3.5% down, but conventional also will allow for 3% down as well in some cases. So the decision between FHA and conventional usually isn't about whether you can put 3% down or not. It's just that in real files, it's more about whether that 3% down conventional approval is going to be comfortable or whether it only works on paper. It's about how the rest of the file looks once you have it structured. So your credit profile, debt ratios, reserves, overall risk of the loan. And that's where FHA sometimes can become a better fit. So for example, I'll see situations where you technically qualify for 3% down conventional loan, but the margins are tight in certain areas. So like credit is decent, but it's not strong, or debt ratios are pushed to the limit, reserves, savings is light. And in that situation, conventional might technically work, but it can be kind of fragile. So FHA will tend to be more forgiving in those areas, which can make that approval more stable. So credit works the same way. FHA allows lower credit scores than conventional loans, but more importantly, it's more tolerant of how credit issues are evaluated. So like late payments, older collection, shorter credit history, those don't automatically disqualify you the way that you might think or that it does on a conventional loan. What matters more is whether you're more stabilized. So that's why FHA often works when your finances look solid now, even if your credit history isn't perfect. So debt to income ratios are another big factor. And this is one that comes up a lot once you actually start running numbers on a file. So conventional loans typically cap out on a lower debt to income percentage, and FHA will allow those ratios to be higher when the overall file will support it. So if your income is strong, but you're carrying student loans and auto loans and other obligations, FHA may simply allow the deal to work when conventional doesn't, or when conventional would be very tight. So let's talk about mortgage insurance, because this is where FHA usually gets written off. So FHA has two forms of mortgage insurance. There's an upfront premium that gets rolled into the loan amount, and then there's an annual premium that's part of your monthly payment. Conventional has that too, but that insurance is what allows the program to be more flexible. So it's essentially the mechanism that pays for the wider underwriting box that we talked about earlier. And so the trade-off is cost. The important part isn't whether mortgage insurance exists, it's whether the overall structure makes sense for how long you plan to keep that loan. So a lot of FHA loans are not intended to be permanent. They're used to buy sooner, reduce friction in approval, allow credit or income to season so that you can build equity. And then later, once you qualify comfortably for that conventional loan, then the loan can be refinanced and sometimes mortgage insurance can be removed. So that's more of a common path. FHA also comes with loan limits, which vary by county. And in most markets, those limits are more than enough for entry level and mid-range purchases. So there's also going to be property standards. FHA requires the home to meet basic livability and safety guidelines. So that can matter if the property needs work, but it's rarely an issue on standard homes. And renovation loans also exist under FHA as well, but that's a separate discussion. So when does FHA usually make sense? It tends to come into the conversation for you when conventional approvals are tight. Maybe credit history isn't clean, but it's stable. Debt ratios are higher, or the borrower wants more forgiving structure up front. So it's not about choosing necessarily the easier loan. It's about choosing the loan that fits the file. So if you're comparing FHA to conventional and you're trying to understand which structure actually works best for your situation, then that's the type of breakdown that we'll continue to do here. If this kind of explanation is helpful, make sure that you follow or subscribe so that you don't miss a future episode. And if you want to dig in deeper on the outside of this podcast, then you'll find tools and resources at clearmortgageplan.com to help you compare options and think through the numbers and those different options. So I'll catch you on the next episode. Thanks for listening, and I appreciate you, and we'll be back next week.